through that strategy and go through how it works, and when you come, you know, maybe you'll override that portfolio manager or not, but what's the checklist you kind of go through?
So we look for very high quality businesses, what we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash it's going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, a shopping mall business. And then we say, okay, well, where's it trading? And if there's a wide gap between price and value, you can buy it for 50 cents, it's worth $1.20. Well, then we're going to take a hard look and try to understand why it trades at a deep discount. And once we understand the reasons, we decide, well, these things that we can solve. You know, or can we, in light of the situation, the circumstances, can we be influential in changing these levers that can cause this valuation discrepancy to narrow? And is this a business that, while we're causing the valuation discrepancy to narrow, we can also perhaps contribute to the valuation growing? And if those things are true, we found something that looks quite interesting for us.
And usually this investment philosophy, does it take a week, a month, 3 months to do the research, a year? I mean, you have 10 names. How long?
It depends. I mean, one of the best investments we ever made took us 4 hours to do the work. It was during the financial crisis.
Which was that?
Wachovia Corporation.
Okay.
So I was on my BlackBerry eating breakfast at the Brooklyn Diner in front of my building, and there was a story went across the, I was just, Wall Street Journal headline, Reuters headline, excuse me, went across saying, that Citigroup to acquire the Wachovia banking subsidiaries for $2 in Citigroup stock. Stock was halted. And this was kind of an interesting transaction because they were buying the subsidiaries for Citigroup stock. I figured, this is interesting. What happens to the holding company? So I went back to the, kind of went upstairs to the office and cracked open the 10K, and another member of the team, Mick McGuire, he and I worked on it. And what was interesting is the 1,000-page 10K of Wachovia Corporation, I think 900 pages were on the banking subsidiary. There was fewer than 100 pages on the holding company. And by buying the banking subsidiary, Citi was leaving a holding company which had cash, in Wachovia Securities, A.G. Edwards, they had paid $6-7 billion for it 6 months before, Evergreen Asset Management, and they were taking a $27 billion loss on the sale of the subsidiary. And it also had a liability called non-cumulative perpetual preferred stock, which if you ever want to have a liability in your life, this is the single greatest liability to have. It's a form of equity where you never have to pay a dividend, and when you don't pay them, they don't accumulate. And the worst case is they get a couple directors on the board, and you say hi to them each meeting, and you have this very, and I said, look, this could be our Berkshire Hathaway. And at the end of the day, we figured the asset, in 4 hours we determined the holding company was worth at least $11 to $14 cash, a tax refund that you could carry back the $27 billion loss, recover cash taxes that have been paid. So you have this cash vehicle. You own Wachovia Securities, which is a good wealth management business. Mm-hmm. You own A.G. Edwards, another interesting asset. These are businesses you know well. And the stock opened after it was halted at $1.84. So we said, look, it's worth 11 to 14, $1.84. We bought 42% of the volume for the next 4 days. And then it was acquired by, then Wells came in and put in a topping bid of $7 in Wells Fargo stock, which wasn't actually a topping bid. But the Wells Fargo deal did not require government assistance.
Right.
So I think Sheila Bair liked
I remember that.
I
actually interviewed Sheila Bair.
Has been convinced by the media, the print media, the radio, the television media, that they don't have a chance. That they don't. The big institutions with all their computers and all their degrees and all their money have all the edges, and it just isn't true at all. And when they're convinced, when this happens, when this occurs, people act accordingly. When they believe it, they buy stocks for a week, and they buy options, and they buy the Chile fund this week, and next week it's the Argentina fund, and they get results proportionate to that kind of investing. And that's very bothersome. I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on usual lows, they push them on usual highs. For someone that can sit back and have their own opinion and know something about an industry, this is a positive. It's not a negative. So that's what I want to talk about. And the single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say, the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks.
We have to deal in things that we're capable of understanding. And then, once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. And then, of course, we would vastly prefer a management in place with a lot of integrity and talent. And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life. That's a very simple set of ideas. And the reason that our ideas have not spread faster is they're too simple. The professional classes can't justify their existence if that's all they have to say.
Let's get rolling. One of the easiest ways I identify potential Kramer names for Mad Money, the stocks that could but won't necessarily always end up on the show, is by watching my favorite list from when I was, frankly, a little boy in 5th grade. I used to look at the new high list. I thought it was like the guys who were hitting better than 300 in baseball. Stocks on that illustrious list, the highest of the high, obviously have something going for them, and that's especially true when the market's in bad shape, as only the best of the best can hit new highs when the market's falling apart. So what's it tell you when a stock hits the new high? Either that it's part of a genuine bull market, or the company itself has some serious earnings or sales momentum, or maybe its sector does, which is so often responsible for a stock's increase. No matter how they get there, many stocks on the new high list often keep going higher because it's really a list of A students that are worth investing in. The A students tend to repeat themselves in the process every quarter, just like the really smart kids in school. In a great bull market like we've had from the bottom in 2009, and any market, by the way, that doubles from the bottom has to be considered a great bull market. Even as I know so many resist such labels, we saw this new high list phenomena over and over again. The same stock would hit new high after new high after new high, and following them was a great way to make money, even as the bears claimed endlessly that the bull market was false and couldn't be trusted. Listening to the bears caused you to miss out on one of the greatest rallies in history. Now, obviously, the rally since the bottom is more like the exception than the rule over time of all the years I've followed the market. But generally speaking, things have will continue to work. Because these stocks typically represent companies that are best of breed. Always remember that phrase because it's integral to Mad Money. I am not saying that just so you can chase stocks that are hitting their new highs because they'll keep going higher. That would be the ultimate foolishness. True bozo the clown behavior when I used to have hair. I am saying that if you want to identify stocks that will be winners in the future, unless there's been a big sea change in the market caused by maybe a gigantic political shift or a radical shift dramatically higher in interest rates, looking at the biggest winners of the present is a pretty good place to try to figure out the future.
And the most important thing to keep in mind if you're investing in stocks is what?
It's always getting more for your money than you pay. it's like buying anything else. And
What's the biggest mistake people make, though?
Well, the biggest mistake they make is listening to a lot of other people and buying something because they think it's going to go up next week or next month. And for whatever reason people give you, you should understand what you buy. Now, if you buy a farm, you look at the farm and you say, I expect to get so many bushels per acre of corn or soybeans, and you figure out how much that'll be worth, and then you figure out what the price should be. If you buy an apartment house, you look at what the rentals will be and what the taxes and expenses will be, and then you decide how much income you'll have, and you pay a fair price for that. But you don't, in stocks, people, their neighbor whispers something to them, and they run out and spend money that it took them years to earn. So you always want to look at the productive ability of the asset you're buying, whether it's a farm, apartment house or a company, but the company is represented by a stock. And if you always get your money's worth, you'll do very well.